Hey everyone, I'm Brian, and this is a quick overview of the fundamentals of valuation. So to start out, these are the main four valuation techniques that you're going to hear about and you'll need to know. We'll be focusing on public comps and DCFs in this presentation, but it's good to know a little bit about precedents or acquisition comparables and LBOs. So first off, we'll be talking about public comps. Let's start out with an analogy. How would you value an apartment? You could value it by size, but two homes with the same square footage may not necessarily be the same price, especially if they're in different locations like New York and Nebraska. So you could try to value an apartment by comparing it to the valuations of apartments that are very similar to it. Public comps does this with companies. So we try to value a company by looking at valuations of other similar companies. Specifically, we're going to look at valuation multiples. So what are multiples and why do we use them? So an example of a multiple using our previous analogy to apartments would be price per square feet. Multiples are almost always going to take the same form, which is a valuation measure divided by a performance measure. And by dividing by a performance measure, you're able to compare how much a company is valued for each dollar of performance. So it's an apples to apples comparison with other companies. Performance measures are typically profitability metrics such as revenue, EBITDA, EBIT, or net income, and the main valuation measures are enterprise value and equity value. So these are the steps in a public comps analysis. First, you're going to find a group of comparable companies. Then you're going to find valuation and performance measures before calculating multiples. And finally, you're going to compare these multiples across all of the comparable companies. So the first step in doing a public comps analysis is to find a comparable peer group. There's no perfect way to do this, and on the job, you tend to have templates with a list of comparable companies. But one way that you could do this yourself would be to look for operational similarities, such as industry and products, and financial similarities, such as size and growth. And you can find this information in a variety of places. You should definitely look at financial reports, such as 10Ks, sell-side research reports, and financial news sources. Next, you're going to calculate the valuation measures. This is where you need to know the difference between equity value and enterprise value. Equity value is pretty simple, and you've probably heard it referred to as market cap. It's calculated by multiplying share price by the number of shares, and it's the market value available to only equity investors. And enterprise value, on the other hand, is a little bit more complicated, but it's the value of the entire firm available to both equity and debt holders. And enterprise value equals equity value plus net debt plus preferred stock plus minority interest. This is a pretty comprehensive equation, and you can usually get away with using the simpler one, which is just enterprise value equals equity value plus net debt. Next, you're going to find the performance measures, and you should try to find a profitability metric that is consistent across different companies, even those with different capital structures or accounting practices. You use different performance measures from time to time, but EBITDA is a pretty popular one that you should know. So next, you're going to calculate the multiples. There are enterprise value multiples and equity value multiples. This is a little bit of an advanced topic if you're a beginner, so don't worry if you don't understand it completely. But equity value multiples are generally used by equity investors, and you'll get classic metrics like the PE ratio or price to earnings, which is written here as share price over earnings per share or EPS. And the enterprise value multiples are a little bit harder to understand at first, but a good way to think about it is from the perspective of a debt holder. So they don't care about equity value because it doesn't include debt. And they don't care about something like net income because that's after interest is paid off. So a multiple at the bottom there, like equity value over EBITDA, wouldn't make much sense because debt investors don't care about equity value, and equity investors don't care that much about EBITDA. So finally, you're going to analyze the results and compare multiples. And this is an example of what a Finnish public comps analysis would look like. Typically, you would probably do more companies than just 5, but you can still see how the types of multiples are presented and how they're calculated, and especially taking note of the average and the median there at the bottom. So moving on from public comps, let's talk about DCFs. So a DCF is different from public comps because it is an intrinsic valuation. So we don't care what the market thinks or how other companies are doing. We only care about one thing, the present value of future cash flows. So you need to understand the concept of present and future values to understand a DCF. And there are three main steps to a DCF analysis. You're going to want to calculate a discount rate, which is usually WACC. You need to forecast free cash flows, and you need to determine the terminal value of the company. So first, you need to understand what discount rates are. So if you take $100 and use it, maybe investing it to make $1 in a year, would you consider that a success? Not really, because you can buy a very low risk bond and make a similar amount, or you could have invested in equities and maybe made $3 or $5 or $8. So to understand the value of money in the future, you need to understand how much money you could reasonably make in that period of time. And you typically do that by applying a discount rate to the future value to get the present value. So for example, if my annual discount rate is 1%, then that $101 next year has a present value of $100. Also, discount rates are different depending on who's doing the investing or the lending. So a big company would probably get a lower interest rate on a loan than you or me would, because the bank would be more confident that a big company would pay it back than they are in the ability for you or me to pay it back. And in a DCF, we usually use the weighted average cost of capital, or WACC, as our discount rate. And WACC is a weighted average of the cost of equity and the cost of debt. So you calculate the cost of equity by finding the risk-free rate using usually the yield on a 10-year government bond, because you're guaranteed by the US government to get paid that yield, so it is considered to be risk-free. Next, you find the beta of the company's stock, which is the correlation of that company's stock price compared to the market as a whole. Next, you're going to calculate the risk premium, which is the difference between expected earnings in the market and the risk-free rate, which is usually around 5 to 7%. And finally, you add all of those items together to get the cost of equity. Cost of debt is definitely simpler and more intuitive. You just find the interest rate that the company would pay out on a debt instrument, such as yield on a corporate bond, and you multiply it by 1 minus the tax rate, because debt is tax deductible. And less risky companies will have a lower interest rate and therefore a lower cost of debt. So after you calculate WACC, you're going to want to calculate and project out unlevered free cash flow. You can make this calculation more complex and accurate, as many things in finance, but this is still a good way to approach it that gets you most of the way there and is pretty simple. So the main idea is that you start with tax-affected EBIT, which is also called EBI or NOPAT, and adjust for cash inflows and outflows that aren't accounted for on the income statement. So first, you're going to add back D&A, because that was a non-cash expense that reduced tax-affected EBIT. So we add it back here to account for the fact that there was no actual cash outflow from that D&A. Next, you subtract CapEx, which is a cash expense that isn't accounted for on the income statement. Then you adjust for change in working capital. Working capital is defined as current assets except cash minus current liabilities. And we adjust for this because if assets went up and therefore working capital went up, you must have paid cash for those assets. And the opposite is true for liabilities. So a positive change in working capital will reduce unlevered free cash flow, but a negative change in working capital will increase unlevered free cash flow. Then once you've calculated unlevered free cash flow, you'll project it out for usually around 5 to 10 years, because it's hard to project cash flows out accurately beyond that period of time. The last step of a DCF is finding the terminal value. So remember that a DCF says that a company is worth the present value of its future cash flows, but we only project out cash flows for 5 to 10 years. So we account for cash flows beyond that period by calculating terminal value. First method that you could use is pretty simple. You take an exit multiple, like the ones that we found in public comps, and apply it to the final year's data. So if you have an enterprise value over EBITDA multiple, you multiply it by final year EBITDA to get your terminal value. The other method is perpetuity growth, which assumes a constant growth rate that'll go on basically forever. So you apply the formula on the screen and you make sure that your growth rate is a reasonable number and is lower than WACC, because if it's higher than WACC, your terminal value will not converge. So the very last step of a DCF is to actually calculate your valuation. So you take the present value of cash flows and terminal value using your discount rate, and then add them together to get enterprise value. And if you're looking for equity value, subtract net debt from enterprise value. And then if you want per share data, you can divide the equity value by the number of diluted shares to get your share price. So this wraps up the crash course on valuation, and thanks for listening.